All right. So thank you both for being here. And for anyone that walks in, they can grab a seat anywhere else, and Rosetta will guide them. I'm Denny Troncoso. I am a licensed loan originator, typically synonymous with the word mortgage broker or loan officer. I really kind of go by more, in the world, people know as mortgage broker, right? Because I work with multiple lenders. And I'll talk a little bit about me. So I first thank you for being here today. And Rosetta, first I'll start and I'll talk about lending today, and I'll kind of keep it a bit open. Talk for about, we said it was about 5 hours I'm going to talk for. Probably about 30, 45 minutes, all right? All right? And depending on the amount of questions, but I'll try to keep simple questions and be able to answer them for you, but also have time for questions after as well, all right? Rosetta and I know each other from the Realtor Association. I am a business member at the Realtor Association. I forget what they call it exactly. It's like affiliated partner or something down that line. And we met through the association as I sponsored a lunch, and then we kind of have been working together in different events and doing our first time home buyer. So I'm excited we're getting this off the ground, all right? A little bit about me. So founder of Coastal Capital Group. Like I mentioned, a licensed loan originator. Some of my information is at the top there. Personal financial advisor. So I used to have my investment license, helping people with 401ks, IRAs in the past, helping them with debt consolidation. That's really how I started. I used to help people to help structure ways to pay off their debt, whether that be with a mortgage or using debt stacking or using private lending, personal loans, doing plans to how can you snowball the payoff of the debt, right? So that was the goal. That's how I started in mortgages back in 2005, right? For a short time later, I actually left mortgages, started just really working in real estate investing and finance. And then I'm working back in mortgages now. So I have 20 years of experience in the finance field, whether it's investing, mortgages, or real estate. I went to UCF, I graduated from UCF, and then I don't talk about it a lot here, but I also went to USF, and I don't talk about it because they're rivals. So my wife and we have that problem because she went to USF as well, and she doesn't like the UCF start. I'm a homeowner and real estate investor since about 2010, right? So I'm proud of that, and I say that so I can help guide you in that path, right? And the last thing, I'm a coach, and I don't want to say a professional coach. I'm a coach from my son. I have a 3-year-old, and I coach his t-ball team, right here at Meadowbrook. So I have fun doing that. Soccer I tried, but t-ball is his sport, right? So, they go to Meadowbrook. They used to. Okay, they have football there, they have soccer, and then they have t-ball. And so I have fun with that on Saturdays. And then I'm a mentor. I've mentored with Take Stock in Children over at the Westport High School. It's tough mentoring high school students, but I do my best, right? I'm doing my best. Toastmasters is a public speaking club, so I enjoy that. And so is Rosetta. She's also a Toastmaster. The last thing is I'm a bookworm, so I like to read a lot. So I like to read, especially about finance and investing and all that. So I bring that. So I kind of want to be also not only the mortgage person, but also the finance person that is on your team, right? So that's it. Born in the Dominican Republic. I got here when I was 3. I grew up in Orlando and New York City a little bit. And I speak Spanish. I speak Spanish and a little French, just enough to be dangerous, right? So today we're gonna keep it to English, but in the future there will be courses in Spanish as well, right? So then we'll be doing that as well. So talked a little bit about me, how long I have been doing this. Now, why is important? Why is homeownership important, right? And I put on here stability and long-term financial growth. So one of the ways in the United States that people build wealth, and the number one way, I know you can build a business, I know business ownership is fantastic, but the number one way is home ownership.
Yes.
Home ownership.
Yeah.
You're paying money for yourself, so you're paying down a debt, and you're putting, every time you pay that loan, money goes into your wealth bucket, into your pocket, to your net worth, but then also that home appreciates in value. Most of the time, it appreciates in value. So that's the way that people build wealth here in the United States. And really, that's why I'm passionate about being a mortgage broker and helping people buy homes, because more people can build wealth. And it's kind of like the church, Meadowbrook, they call it a growth track. I call it wealth track, right? Start with a home, then maybe you can do other things. You can buy an investment property. Maybe you can start, can own a business as well. Business ownership is great, but it's not for everybody. So, but home ownership can for everyone.
Yes.
Right? So, and that's why I'm excited to be here today. the home loan basics. So what is a mortgage? And simplifying it, right? Because people don't really want a mortgage. They want a home, right? But you have to go through the home to get the mortgage. And what is it? It's a loan to buy a house, right? It's a loan to buy a house. That's simple. This is the simple thing. You pay it back with interest over time, and there's different types of loans when you get started. So there's going to be a loan that's called an FHA loan. It's a very popular loan. It's a government loan. And there's a loan that's called a conventional loan. And I just want to simplify it. Conventional is non-government loan, right? So FHA is a government loan. A conventional is a non-government loan. There's other loans if you have a spouse that's a veteran or you're a veteran. It's a VA loan and it's for veterans. So Veterans Affairs, VA, is for veterans. And those are some of the best loans because the interest rates are lower, you have lower down payments, etc. The other loan, and I'm going to come back to FHA and conventional, but there's also a loan called USDA loans, right? And it starts for rural areas, right? So areas that are far away from the city, and there's loans for that too. And those loans are good because you don't have to put as much money down, right? But they're further out if you're willing to live further out, okay? And they're also income-based, so not everyone can get them. Your income has to be within a certain range. So today I want to keep it high level. I want to go over some details, but I don't want to overwhelm you, all right? Because in 30 to 45 minutes, it's kind of going to feel like, drinking out of a whole, So we want to slow education and light. The two loans I want you to focus on, unless you're going to really buy outside, and you can contact me, we can talk about that on the side. Or if you're a veteran, we can talk about that at another time. But today I'm going to talk about FHA loan and conventional. And I want us to be interactive. So let's go ahead and take some notes, all right? So when we write down next to FHA loan, I want you to write down 3.5, 3.5, all right? And stands for the percent of money that you have to put down, 3.5. That's in an FHA loan, all right? Now on a conventional loan, it goes from 3%, okay? Maybe even 0%, but more likely around 3%. All the way up to 20% or more, okay? Now, why do, you may see it on TV or in an article, oh no, 20% down. That's what, 20% down, that's the best, is 20% down. The reason they say that is because that's how you get the best interest rates, that's how you get the better terms. But putting 20% down is not necessary, right? That's not necessary, right? And I actually don't even encourage it unless you already have the money, right? A quick story here, there's a person, they were engineers, professionals, and they went to buy a mortgage, to get a mortgage, but someone told them, hey, put 20% down. So why don't we, okay, we don't have 20, we have 10. Why don't we save to get to the 20? So they started in 2018, I don't know the exact story, but it's 2018, then they saved 2019, then they saved 2020, and then they're ready to buy a home now. They have 20% down. But what happened between 2018 and 2020? The prices of homes went up, all right? So now they can put 20% down, but it's probably not at the same price home that they were gonna buy before. And they lost out on all that price appreciation. So the goal is, in my mind, the goal should be to buy a home as soon as possible. You lock in that home. Now you can take advantage of the equity. And later down the road, if you buy another home, you have that equity, then you can put 20% down, or you can refinance if you have the equity, right? But at least now you're taking advantage of building wealth, right, in that process. Any questions? No? No? That makes sense. All right. So that's FHA loans and conventional loans. So these are the different types of loans. Now, one of the reasons people use FHA loans versus conventional loans, FHA loans have more fees. So write that down. More fees, right? And the fees we're talking about are fees that go to the government and for mortgage insurance premium, right? Where a conventional loan is not going to have as much fees, right? The conventional loan is good, but you cannot have as much debt. I don't want to go into as much, but your debts have to be less than 50% to qualify for a conventional loan. Whereas FHA, you can go closer to 60%. Not all the way there, but close to 60%. So think, if you have a lot of debt, maybe your best bet is FHA, right? But if not, maybe you can go conventional, because conventional is less fees, okay? okay? Less fees, conventional, but lower debt requirement. And when we're debt, we're talking about the debt to income ratio. Now let's talk about fixed rate versus adjustable rate mortgages, right? In most cases, 90% of cases, you want to go with a fixed rate loan, right? A loan that the interest is fixed for 30 years. Here in the United States, we have loans that stay fixed for 30 years. Where I'm from, the Caribbean, all the loans are mostly adjustables. They're not fixed, right? So in the United States, we're able to fix a loan, keep it for 30 years, and that is great. Now, in some cases, we can analyze if there's a difference in the interest rate that it's substantial to get an adjustable. But most of the time, unless you're an investor or unless you're going to be in that home for a short period of time, most of the time I recommend fixed rate mortgages, okay? Fixed rate mortgages. Because you don't want your payment to go up after a certain period of time, right? You want it to stay consistent. Right? You don't want any surprises later. All right? Now, let's talk about pre-qualification versus pre-approval, right? And pre-qualification and pre-approval. So if you are getting a loan and you come to me, Denny, I want to get a loan. This is my credit score. This is how much money I make, right? You didn't provide any documents. Welcome. And you didn't provide any documentation. You want to get a loan. If I don't see your financial information and I don't run it through the system, I didn't run your credit score, I didn't run your income, I consider that a pre-qualification, right? You told me what you have, maybe one pay stub, maybe you told me what your credit score was, maybe you sent it to me. That's more pre-qualified, right? So I don't really know exactly 100% if you're going to get approved. But now, if you provided your pay stub, if I was able to run your credit score, right? First, what I like to do is I like your income first, right? Because we don't want to run your credit because it affects your credit. But after we run your credit, we've checked your income, then we run your credit. Now the system will tell me, approve this type of program. And now I can send you a pre-approval letter. So whenever you're out there looking for homes, it's not just you've been pre-qualified. It's like, no, they already went through your system. They already looked at your financial information. You're ready to go, right? You're ready to go. So what you want is a pre-approval letter. It takes a little bit of more time. I know we're in the age of Amazon, right? We want things like that, but it's better to provide your financial information, have it organized so the person can review it and they can tell you, yes, we're going to be able to do it, right? Because sometimes, frankly, finances sometimes are confusing, right? We're making so much, but sometimes we're self-employed or we get paid a per diem or there's something going on with our income. And it's better to have it reviewed by someone that does this on a consistent basis. And they can tell you, yeah, your income is this. Based on your per diem, this cannot be used. This can be self-employed. What are your losses, etc. We can calculate that, right? So those are the differences between pre-qualification and pre-approval. And I put there pre-qualification an estimate based on self-reported, but pre-approval is verified, right, by documentation. Now, what are the steps in the loan process, right? So the first thing is we do an application. And typically we have a digital application. We send you an email or we send you a text. Hey, you can fill out on your phone, you can fill it out at your home, on your computer, etc. You fill out the application, you provide as much information as possible. I'm on the second page. And then you provide documentation. Documentation is, as I talked about, your income, your credit, which we'll review, and your assets, right? We want to verify if you have other homes or if you're not a homeowner or what assets you have. Maybe you have cash, we want to be able to verify. So we provide that through statements. We'll be able to review that. And then that process after you find a home, now we're going to go into something called underwriting, right? And underwriting is a fancy word for verifying the documents, right? To getting the loan closed. So it's like before closing. The underwriters, they work for the lenders and they review that all the documents are there to get the loan closed. They're going to review that your pay stubs are correct. They're going to review that the bank statements are there. They're going to review that you have the cash to be able to close. They're going to make sure it all meets the requirement. And they're also reviewing, and I know people, you're going through this, man, they're asking for so much information. These loans get purchased by the government. right? So there's something called Fannie Mae, Freddie Mac. They buy loans. So the lenders take these loans, they buy them, and then they can do more loans. That's how it works, right? So they do a loan now, use their cash, then they get more cash, and they keep doing loans. So the loans have to fit a certain box. They can't miss a document. They can't not verify your pay stub, because if they do, then they can't sell the loan, and then they can't. So that's just a process of them checking all the boxes, making sure that everything is there. And that's why underwriting is probably not the favorite part of everyone when they're buying a home, right? And I kind of say, hey, look, it's like going to the dentist, right? And getting a cleaning. It sucks, right? Nobody really enjoys getting a cleaning, right? We could be hanging out with our friends. We could be doing so many other fun things. But hey, we got to get our cleanings done, right? To make sure our teeth are good. And that's just the process of underwriting, right? Any questions there so far? No? There you go.
And
right?
I love going
They're
to the
important.
dentist, getting it clean.
They're important, but not most people don't. Okay, I actually love my dental hygienist. She told me about the best ice cream place in Ocala. I don't know if you know about that, but we'll talk about that later. Okay, and my hygienist. Isn't that crazy? The person supposed to be taking care of my teeth, but hey, I love it. I love it. All right, so what is the timeline, right? So now we went to underwriting, and then now we get to the part that you want, the part that you're here for, right? Closing. Closing means signing the documents. So write that down. Signing the documents. That's closing. It's nothing else. It's just reviewing all the numbers and signing the documents. What I like to do before closing, because you're going to get a whole bunch of paperwork. After we do the application and you provide documentation, you're going to get something called a loan estimate. Write that down. Loan estimate. That's going to have all of the detailed costs and estimated costs of when you close. So 30, 45 days from now, as the lender, my job is to get a good estimate on how much everything is going to cost. So you know how much money you're going to need when we get to closing, right? Some of that may be a little higher because I don't know exactly how much a survey is, right? Because surveys can change. Some of that may be, there could be an inspection. I don't know which inspector you're going to use. So I made $500, but maybe you find John who does it for $300, or Johnny, right? So it just depends. So I'm putting estimates there. Now, after that, we go through the process. You find your home. We're ready to close. Now you're going to get something called, they call it the CD for short, but it's called the closing disclosure. Closing disclosure. And now all of the detailed documents at same costs, but now the costs are final. The costs are final. This is how much it's going to be when you show up at the closing table. And what I like to do, the closing disclosure, you have to get it within 7 days before closing, right? But also, I like to get you the closing documents at least a couple of days before is the goal. It doesn't always work out this way because, at the end, everybody's pushing for the time. But I try to get you the documents at least the day before so you can go over them. And when you get to the closing, you're not like, oh my God, what is this, right? You've already looked at the documents. You're already familiar with the documents. You know what you're going to be signing. And it's just repeating the process. So you're going to get that at closing. Now you're going to get all the closing documents that you're going to sign for the loan, right? A mix of documents there. I don't want to go into too much detail, but there's a note, which means you're going to sign for the debt, right? And then the mortgage, which is really saying, I'm going to pay this, and if I don't pay it, then they take the house, right? So you're going to sign all those documents. Now, it takes 30 to 45 days from when you find a house or refinance, if you refinance, to go ahead and do closing. Can we close faster? Yes, we can close in 20 days. Maybe we can close in 15 days. But it depends on how fast we receive documents from you, right? The lenders may say, I need this document, your pay stub, I need this bank statement, I need a verification of employment. Sometimes things just take time. You have to be patient through the process. But out in this process, and I know people don't like the messenger, I am on your team, right? I want to get the loan approved. If I don't get the loan approved, I don't get compensated, right? There's no fee for Denny, right? And I have a 3-year-old who eats a lot of food, right? Right? So I have to close. So at the end of the day, I just want to tell you, a lot of people, they get frustrated with the process. I'm on your team too. I'm frustrated with the process too, but I'm just going to work to get it done. I'm not going to complain. I'm going to get the process done. And that's what I'm here for. If you rub your back a little bit, it's going to be okay. We're going to get through this. but my job is to get the loan closed.
Say a little prayer.
Say a little prayer, right? You know, I'll listen to you, but the goal is to get it closed, right? I'm not against you, right? Some people think, hey, no, Denny, these bankers, Denny. No, I'm on your team. Get this done, right? And then, so you can invite me to your house so we can eat some food, right?
Yes.
Celebrate. All right, now, the down payment and closing costs. How are we doing on time? We're almost there. Down payment and closing costs. I went over this a little bit, unconventional. It can start all the way to 3%, all the way to 20%. It can go up. Again, get into the home as soon as you can. Lock in the prices today. We don't know what's going to happen in the future with home prices. Can the prices drop like they did in 2008? It's possible. Is it likely? Is it probable? No. Right? What's more likely? Most likely is that you're going to be a little bit higher than last year. In most markets, how can I say in Ocala, it's probably going to be higher because more people are moving to Ocala,
Yes,
right? If Ocala is growing, the prices are going to be higher because there's more people that need homes and there's not as many homes, right? If people are moving out of a city, maybe some places in the Midwest, which I think is changing, maybe New York, certain places, maybe those cities are experiencing a decline in values, but not in Ocala, right? Not in Florida, in most cities, I'd say, in the north part of Florida, okay? Miami either. Miami's growing because of a lot of immigration that's coming into Miami. But I digress. Now, what are the down payment options? So you can get from either a payment assistance program, which a lot of people use the word first-time home buyer, right? Now, what is a first-time home buyer? I kind of look at it, it's a term that's used a lot, and I look at it like full coverage insurance. What does that mean, right? What does home first buyer program mean? Well, the technical term is that you own the home in the last 3 years. That's how a first-time home buyer is. So if you want to write that down, have not owned a home in the last 3 years. Now, there's money that's available for people that haven't owned homes in the last 3 years. See, it's not about just a home buyer. It's about the money, right? The programs.
Yeah.
Now, where do the programs come from? The programs can come from the local county government, the city government, sometimes the state. There was a program last year called Hometown Heroes, right? That's available. Now, those programs, and sometimes they even come from the lenders as well. Like some of the lenders I work with have some down payment assistance program. However, that money, you have to really be on top to find it. It's not as easy as it sounds to find it. You have to be really diligent, you have to be really organized, and you have to be really, searching to find it because most of the time it's gone, right? Because everybody's looking for it, right?
I have a question.
Yes, ma'am.
Is it for the client themselves to look for it or the mortgage person to help look for it?
Great question. I would say both.
Okay.
I would say both. And the reason behind it is there's programs, I know a lot about mortgages and I know a lot about programs, but there may be a program out there with a special nonprofit that's available that I don't know about, that you found out about, right? And that it takes work to find those programs. You would start with...
Where would you begin to look?
Good question. The first thing I would say is to Google. Google's your friend. Start with that and see where it leads you, right? Some of the problems too, I had to contact the down payment assistance program here in Marion County, but sometimes it's even hard to get in touch with them, right? And to get a response back to see if there's even funds available. Hometown Heroes was a great program that the state released. That really came from one of the stimulus programs, I believe, that the state got excess money and then they released it for down payment. Yeah, but in like 2 months, the money was gone.
Yeah, and I also, when I'm working with my clients, when I'm working with the MLS, I can also see some of the down payment assistance. They will have financial availability on those properties or whatever. They are on the MLS as well. That's the reason why you use your realtor, so that they can help you out.
There you go. Now with the lending programs, I know about those right away because a lender will say, hey, we have $5,000 in down payment assistance available. And now that's, right away, I know it's available. I know it's easy to access. then that'll be available for the clients, right? But the down payment assistance programs, I've really worked to try to those programs for a lot of the folks, but frankly, it's been very challenging. And also with the hurricanes in Florida, what happens too is they freeze those funds and they go toward helping other people find housing as well. So I'm dealing with a customer there. There's down payment assistance programs in certain areas. They said, no, right now we've frozen it. We're only focused on helping people with the hurricanes process because now they don't have homes. They're help them to,
How many programs can you participate in?
It depends on the program itself. That they'll tell you sometimes they'll have guidelines and they'll say cannot be combined or can be combined.
Yeah.
So you have to go by program to see. Some programs you can stack them together, right? But you really have to read the guidelines of each program.
Yeah.
Right?
The first house I sold, the woman, the young lady came in with like 3 or 4 different programs because she was a school teacher. She was first-time homeowner. She was this, so she had like 4 different programs, and it was a paper, stack of papers like this to be going through all of those programs to bring it for the mortgage. But that's the only way she could afford it. So.
Yes. Yeah. It depends on the program.
Yes.
Every program is different.
It's different.
Yeah.
Yes.
Some credits may say your credit score needs to be 620. Like I have a program, it was 620 is the minimum. And that program, a customer at 617 don't qualify, right? And then the same program, some other program is if you're moving from an expensive area, let's say you're in Tampa, Orlando, Miami, AMI is over the area median income is certain amount, you can get $5,000-$6,000, right? But if you're in Ocala, this program doesn't qualify, right? Because the area is not that expensive. So it really depends on the specific program, right?
Some of them are income-based?
Some of them are income and some are not, right? Like this specific one, I'm not 100% sure. I think that it wasn't income-based. I think it was just in the area. They looked at the area median income and it says if you live here, then you can qualify to buy somewhere else. I think is what it was. So, but either program. And so my job is you find, like let's say we find a program, right? But let's say you find something, right? You send it to me, right? I review the guidelines, right? And say, okay, yes or no. First thing is you got to see if there's money available. Are there funds available? Yes. All right. And then let's look at the guidelines. And then do the guidelines say yes or no, right? And that's just reading through it to make sure. Good questions? Good questions. Continue. All right. So we got the down payment. Where else can the money come from? It can come from savings, right? So you're saving up for the assistance. It can come from a gift, a friend or a family member. I know it's harder to do that unless you have, some wealthy family members or parents. They can give you a gift or something. It can come from there. But a place where it cannot come from the seller, right? So the sellers can help you with the next one, the closing costs. Yeah. So whenever you're going to buy a house, there's costs to buy a home, right? There's origination costs. There's costs for underwriting. There's costs for closing taxes, transfer taxes for the state. There's the title premium, the insurance premium, all that. Those are all costs that you have to pay for, right? It's typically 2 to 5% of a loan, right? The seller can pay for those things. And this is where your realtor comes in, and it's a negotiation. You request it from the seller. Can you pay for this, right? And some people, they only have the money for the down payment, right? And they need to find a seller that's willing to do the closing costs. I actually have a customer right now that the realtor, we're working together. They need money for closing costs. And, so one of the things is really, before you even kind of look at houses, you kind of have you like it. Let's say you look at the house online. Hey, it looks good. Before you even waste time, go looking at it. Send a message to the seller's agent. Hey, look, we're interested. We need closing costs. Can you guys do this? Right? This is the realtor kind of working with you. Save time. And then some of the sellers may say, yes, we're willing to do this amount of closing costs. We're willing to do 4%. We're willing to do 5%. The maximum percentage on an FHA loan, on a conventional loan, is about 6%. 6%, okay, for closing costs. Now, if you get more than that, great, but you can't use it unless it's for closing costs. You're not gonna get cash at closing, all that. Makes sense? And you can't use it for your down payment. Your down payment has to come out of your pocket or as a gift, etc.
Is this being processed at the same time, so are the sellers waiting on the check and then they pay?
It doesn't take it out of the loan. It takes it right at the closing table. Whenever we do the closing, that's where the closing money kind of gets separated by the title company. They call it either a title company or an attorney, and they pay the seller. Instead of the seller, let's say they're giving you 6,000, they would they're going to get 100,000. They out of their money that they were going to get. And they were going to do. And there's tricks to that too. You know, it's a I don't want to say tricks, but it's a negotiation. Sometimes the realtor may say, hey, look, the house is 200. We'll offer, 226, so you can get 6,000 for closing, right? Now, will the house appraise? This is the realtor now, right? Now, these are things you have to do. And then also, then another thing, will the house appraise? Would you be able to get a loan for 226, right? Or was your limit 220, right? So kind of, when we're doing these loans, and I kind of sharing this with you, we're trying to find a balance here, right? Especially when it's a first home buyer. So it's very important that you trust your realtor and that you trust your lender, because we're trying to guide you and we're trying to make sure you don't fall off the seesaw, right? Because it's a little of a process. It's a dance. The dance has to come out well. If not, it won't close, right? And we don't want to get to the closing table and you spend $500 for inspections and $1,000 or $500 for appraisal, and then now we're not going to close. And it's like, man, this is so frustrating. The home ownership, all that. So, yes, ma'am.
Does do you know, 401k IRA type first home?
No, that actually doesn't affect the program. That's just, it's considered part of your savings, right? And what the good thing is the 401ks, IRAs, they have, you could either take a loan, but sometimes they'll allow you to, without having to pay a penalty for a certain amount. I don't know what the exact amount is today, but it's to verify what that is, and then you can withdraw that and you can use that money from your 401k or IRA to buy the home for the down payment. That's a great point as well. They're the savings component. So sources for closing costs, savings, seller credits, assistance programs. You can use down payment assistance to cover closing costs as well. Right? So that's something. Credit score and financial readiness. We have importance of credit scores. It affects loan approval and the interest rates. Typically, you want to have a credit score around at least 580 or higher, right? We can do loans for lower than that. I'm actually working with some lenders to be able to help somebody now with as low as a 520. But what happens is sometimes then you have to put maybe more money down, or your interest rate will be higher. So it's possible, right? I don't want you to discount it. It's possible, but it is going to cost more money for that type of loan, right? So we want to hopefully get to 580, get to 620 or higher, because then we have better terms that are coming in there. Yeah, right? And then I can help you with that a bit, right? So I can give you some basic credit advice on how you can make sure to maximize your credit. So this is just free tips, credit tips, okay? Now, if we go to the next level, there's something we can do. It's called a rescore process. So we can pull your credit. It's called a soft pull. It doesn't affect your credit. We get to see what your score is, and we get to see what's affecting your score. And then it'll tell us right now, short term, what's affecting it, and then what's affecting it long term. So what you can do to improve it. If you want to buy a home in the next month, we can pay the bureaus. This is how they make money. You can pay them. Let's say it says pay off, you owe a credit card, you owe $600. Pay it down to $200. So you pay $400 and your credit score is going to go up around 15 points. You're like, okay, you pay the credit card, you pay the bureau, somewhere around $50 depending. And then now your score goes up 15 points, right? So now you qualify for a program maybe you didn't qualify before, right? So that's something that we also can help you do. And then there's credit repair, which is trying to challenge some of the debt that you have, which I don't do that, but I can refer to people that can do that if you need that type of assistance as well. All right. Questions? No. So credit scores. Now the tips, I kind of talked, there's a little bit of tips there. One thing I want to talk about credit score is not only the credit score, but also what's on your credit history, right? So let's say if there's a foreclosure, short sale, bankruptcy, those do have some waiting periods. Maybe 7 to 10 years on a bankruptcy, short sale, foreclosure, about 4 years, depending on the program, right? Depending on FHA has more flexibility, but that's just some waiting periods there. And then you want to make sure you're making late payments now on your debts, because then now that's going to make it difficult to get approved. Like I had a customer that we almost weren't able to close because I believe they were asking, oh, do I need to pay my mortgage this month? I'm like, yeah, you need to pay it, because if you don't pay it, then and you're refinancing, they're going to decline it, and then you have to wait. If you have more than 2 late payments in 12 months, I think you have to wait 12 months to be able to do it. Yeah, so it's a lot of facts, so you got to be careful there. Debt to income ratio, I didn't want to go too heavy on there, but I want you to think of it on conventional. I mentioned it earlier. Conventional, you can go about, if you make $100,000 a year and your mortgage and your other debts, the total can't be more than $50,000 a year, right? So if you make, let's call it $50,000, easier number, $50,000 a year,
Right.
$25,000 per year is the maximum your mortgage, your credit cards, everything, your car loan, your student loan, you can't have more than that. So you can't pay more than about $2,100 per month. If you do go over that, then you can't go conventional. You would have to go FHA. FHA, you can go a bit higher, right? But then now I get FHA has a little bit more fees. So that's something we have to take into account for closing costs, etc. Right? FHA, you can go up to 57% is the number, but you're not going to remember all that, but just wanted to give you an idea. There's more flexibility if you have more debt with FHA, right? Question? Yes, it depends on the health stuff. If it's in collection, there may be some flexibility there. But if you have debts and you're making payments, they all get it like into a bucket, and then we look at what the total bucket is. Yeah.
I've heard like for different things, those two for some reason don't necessarily always play a role. So that's why I was wondering.
Yeah, for student loans,
Students,
if they're deferred,
definitely.
if you're not paying on them,
That's different.
then that's different. But if you're paying on them, then
That's
yes,
it.
they're going to be calculated. And so does child support. That goes into account as well. Right? So those are all things when you're thinking about buying a home. I don't get to do it enough because I don't start that early in the process with people. Everybody's like, hey, I've been doing this. I'm ready to buy now. It's like, okay. I wish you wouldn't have got that car yet, or maybe waited, because now you qualified for $250, but now you only qualify for $225, right? And of course, everybody, they want that bigger, that home or whatever. And the first home doesn't need to be the dream home either, right? The first home is the starter home. And then you can go to the next home, which is the dream. But at least you can get in the game, right? Now you're a homeowner. Now you're stable. Now you're building wealth. You own it for a few years. Now you learn how the process goes. You make some money on that home. And then you come to Rosetta, you come to Denny, hey Denny, I'm ready to buy my second home.
Yes.
I want to sell this home. I want to rent it out. And then I want to buy another home. So let's refinance this one, buy another one. Or let's sell this one, buy another one. So it's like a stepping stones. All right. I got about 5 minutes. So monthly mortgage payments, your payment's going to include a few things in the numbers. Your principal, how much it's going down every month, the interest you're paying to the bank, the taxes you're paying to the city, the insurance that you're paying to protect your house that are required by the bank. But there's 2 other things that you require as well. There's private mortgage insurance, because if you borrow less than more than 80%, then they're going to charge an extra insurance. It's somewhere around $50 to $150. It starts around there depending on what type of loan. But then also there's an HOA that you also have to take into account. So HOA is a homeowners association, and that typically it's a townhome community. They're going to have an HOA. Townhome. And not only are they going to have an HOA, but they're going to be pretty pricey. Typically it's about $200 to $300 a month or higher. Unless you have the money, I highly encourage you as a first-time homeowner to try to stay in places where either there's no HOA or there's a low HOA, right? It's a low HOA or no HOA. Because there's some positives and negatives to it. HOA helps to maintain home values, right? However, it does limit you on how much you can buy, because that money, maybe you would be able to afford a $300,000 home, but because of the HOA, now you only can afford $250,000, right? So those are things to take into account. They may have restrictions, but you may be okay with them. Sometimes maybe the HOA, you can't rent the house out more than a certain amount of time, or you can't park on the grass, which really is a county ordinance, but they're kind of strict. You can't paint the houses. There's certain restrictions on it, which sound bad, but sometimes they're good. Some people like them because sometimes they lower your home values, right? Parking on the grass is okay, but sometimes it looks bad on the neighborhood sometimes, right? If people are not taking care of their house, that's bad for your house, right? Because then now your house is affected, right? But an HOA is going to be strict on that, possibly. It depends on how active the HOA is. Sometimes you pay the money and you're not getting anything for it, right? Sometimes you have a pool in an HOA. So you don't have to have a pool at home, it's expensive, but you're paying an HOA and they cover the pool, or they cover cable, or they cover certain other things. There's other benefits that come with HOAs, right? Every HOA is different. You gotta read the documents, and that's something that comes before the closing too, that you can review it. Really, it should go whenever you're looking at the house and going over with your realtor before you make an offer. You should review what are the requirements of the HOA, see if it's worth it. Okay. I live in an HOA, but it's a small. They just dissolved it. I live in the county. We're paying $50 a year, and they're like, oh, we're not really doing anything with this. They just dissolved. No more HOA.
Oh, did they?
And it was $50 a year. But I mean, I don't even know what the $50 was going for, frankly. I don't really care because it was $50.
Yeah.
But they're like, oh no, we're not doing any anymore. We just dissolved it. So well, before they said I couldn't have chickens, but now there's no HOA. So
you can have some chickens.
I had 4 chickens. Now I only have 3. There was a raccoon that happened to me just this past week on Monday, I think is what it was. I'm still dealing with it. Yeah, I got the chicken when it was a baby, and then it was been already like close to a year, and it was laying eggs, everything, and then a raccoon got in the coop. Yeah, but that's another story. Okay, so moving on, common mistakes to avoid: opening new credit lines before closing. Don't go buy furniture.
No.
Don't go buy a car.
No.
Don't sign on someone's loan before closing. Do it after closing.
Yeah.
I don't recommend signing on anybody's loan. Yeah. But if you're gonna do any of that, do it after closing. Because if you do, you may not be able to buy a house at that time. Because now your credit is there until you pay that off, right? So don't do it. Don't change jobs in the process. Maybe it can be overcome, but that's bumpy. Now we need new pay stubs. Now we need a job change. Now are you doing the same job? Typically you want to be in the same job or working for at least 2 years to be able to qualify to buy a home. Now, if you change jobs in the process, is it in the same industry? Maybe not. So let's not change. Let's just stay with the same job. Let's buy the house, then you can change, right?
Yes.
It's not a hard rule, but it's not a hard rule, but it's a hard rule because it's difficult to overcome. Because now we need more explanations. It's going to take more time to close.
Because like our job just got purchased.
Okay.
So
it can be overcome, but if it's beyond your control. But this is what I would say is, and I'm looking at it from this way. We start working together. You're going to buy a house. You go under contract, right? We're going to close in 30 days. And you change jobs. Don't do that, right? Do it before. Now we have new pay stubs already. You're already established in your position. Then we can do it. Now it's a little bit of a smoother process.
Yes.
Right? Can we work with it? Possibly we can. We're going to do our best to work with everything. But what I'm trying to do is increase the probabilities of closing. You understand?
Yes.
Whatever we do that increase the probabilities of closing is positive. Yeah, go for it.
Well, she knows. I work in the hospital.
Okay.
But I was different department.
Okay.
And that's not gonna affect me.
No, that wouldn't affect you. Okay. If it's the hospital, you're still working in healthcare.
Yes.
Same industry, it'll work. But now, let's say if you were like working as a nurse, right? And then you go and worked at a factory, right?
No.
Or a completely different industry, right? Or something different. So then no. If it was administration to administration, even if it's a different industry, then it's administration. But it depends on the profession is where the problems come. And it's not that difficult to overcome. I don't want to scare you, but I'm trying to make the process, okay? Smooth. And then the other one is not budgeting for home maintenance, right? So even if you can afford, I always tell people, start with your budget, right? How much do you want to pay? $1,500. Realistic budget too.
Yes.
So talk to Denny, talk to Rosetta. I want to buy a house, but my budget is this. How much can I afford? Hey, you can afford $200,000 on that home. Okay. Rosetta, 200,000 homes in Ocala, or what do I get? Oh no, you can live in the shores. Oh, I don't want to live in the shores. Oh, I want to live over here in southwest side of town. Well, those homes are 300,000. Those homes are 350. So that means your payment's going to be 1,800 or 2,000, right? Maybe you can afford that, but you wanted your payment to be lower, right? So what I'm saying is to be realistic and use your team to see what is realistic, right? Because another thing too is sometimes rents, they're lower, but are they going to be higher soon, right? So maybe you're paying 1,200 now, but in a year from now, are you going to be paying 15? Because rents have been going up in Ocala, right, too. So that's also a word to think about when you're buying. The home buying process, so kind of finishing up here, bringing it around the corner. Consultation, we talk, we have a conversation, whether that be on the phone, via Zoom, in person. After we do that, I kind of do like a 15-minute, hey, let's talk. What are your goals? Where are you at? This, okay, yeah, it sounds good. You sound good. We're comfortable working together. Okay, the next step is send me the financial information, but two-part consultation. And then I get you the pre-approval letter, right? And I get it to Rosetta, your real estate agent. And then you guys go out house hunting. I know, a lot of people, they find the real estate agent first, but the real estate agent, what they do is they're like, go talk to Denny, right? So I think you really need to talk to the lender. But I know why you find the real estate agent first, because you want the house, right? You don't want to talk to me. You're like, money, I don't need them. I just want the house, right? But you have to have money to get the house. But then Rosetta helps you with the house hunting. Then you guys go under contract. Then it goes to underwriting. Then it gets approved. So now, hey, we're approved. We're ready to close, right? So there's pre-approval and then there's loan approval. Now that's cleared to close. That means we can close tomorrow. We can close next week. We can close in a day. And then we do closing. Yes, ma'am.
And I don't know if I missed the pre-approval letter. What is it lasts for?
Good question. It typically lasts from 30 to 60 days, right? And what that letter does is just when you make an offer, it makes the seller comfortable that you can get the loan closed. And it also gives the realtor comfort because realtors have to do a lot of work to drive, to find homes and all that, to also show you homes as well.
Would you say is beneficial to look at homes first? If you're like an indecisive person prior to, because 30, in my head, 30 days with a lifelong commitment, possible lifelong commitment seems so short. But I guess if you didn't, you're ready maybe.
Yeah, I mean, the letter itself can be extended.
Okay.
And what it is we don't want to put it 6 months because your credit is good for 90 days.
Right.
Okay. But we don't want to put it for too long because what if your income changes? What is this? So I would say the letter would be good for 60 to 90 days. But if something changes in that process, you need to let us know because that's going to change that letter, right? And the explanation, that question about locations is a Rosetta question, and Rosetta's getting ready to speak. So I think you should hold that one. For that, but you probably need to at least have a good idea where you want to live, right? I would say before, especially if you're indecisive. But I'll let Rosetta handle that one because she's the real estate agent person. Is owning worth it, right? And kind of just closing out. Is this worth it? Is all this stuff worth it? After all that, I know I talked about ownership, wealth building. I think it is. Stable monthly payment. Your payment's not going to go up for 30 years. Maybe your taxes change, maybe your insurance changes, but if you can lock in a payment, what's better than having stability, right? Instead of next month, my rent, or next year, my rent is say $1,100, then it's gonna go to $1,300, $1,400, $1,500, right? You never know, right? I'm a landlord, I own rental property. If taxes go up and insurance goes up, I have to increase rent, right? To pay the rent. So now the tenant is affected, right? So that's something that if you have a home mortgage, you're like, oh no, I have what is it called? The homeowner's exemption. So it helps you to keep your taxes low. I don't get that as a landlord. I get that for my primary home, but not as a landlord. Wealth growth through equity. Think about it. I forgot what the net worth is. The average net worth in the United States is $350,000 or $500,000 for homeowners. That could be your retirement, right?
Yes.
You buy a home, you own it, you pay it off. The home's paid off now. Then maybe you can turn that into a payment, a stream of income. You put it into an annuity or you put it into an investment or whatever. You buy more homes. Now you have $500,000 to live off of, right? That's wealth. Potential tax benefits, the interest, the money that you pay in rent, you can't deduct it from your taxes. But the interest that you pay on a loan, you can deduct it from your taxes.
Yeah.
That's also helping you as well. Now, I don't say that to own big homes. I'm cautious with that too. Be realistic on the home you buy. Live for free. So once the home is paid off, you can live for free, or you can do a reverse mortgage. And then the last one is you can pass that asset off to your heirs, where either they can live in the home or they can, use that to build wealth, etc. But now you do have to buy in the right market, and you do have to own it long term, right? There's some places it's very expensive to own, like New York City or etc., where renting is maybe better depending on the area, right? But I think still Ocala is a good place to own. Possibly, it depends on the situation. Depends on everybody's situation is different.
Yes.
But, yeah. And then so after the event, I said ready to get started. Introductory call, 15 to 30 minutes. Consultation call, video call, 30 to 60 minutes. We'd love to help you out. And from there, now I'll let Miss Rosetta come up and stop. And now introduce yourself.
Yes, and let's give Denny a hand, y'all. Listen, thank you, Denny. Thank you so very much. Yes. Because I have someone to think, but I think a bottle of water.
That was the goal, is to keep it, easy to understand.
We're gonna take a 5 minute. Can
Okay,
we take a 5
yeah,
minute?
let's take a 5 minute. That's a great idea.
Yes.
Yeah, that's fine. I pause it. Yep.
Okay. Good morning again. I'm Rosetta Harper. I'm a licensed realtor here at Ocala Realty World. And I just want to thank you all again for coming to our first time homeowners workshop. Denny and we met a couple of months ago at our realtor board, and it was just so amazing. I made a phone call to him because I was trying to introduce him, connect him with another client of mine. And he was like, well, Rosetta, what do you want to do? How you want to navigate with the real estate, right? Because I am a new agent here in Ocala, and I just shared with him I would love to do some workshops, some seminars for first-time homeowners, people sharing wisdom on how to purchase a home or how to go about getting refinanced or whatever. And he says, wow, I had that same vision, so why don't we connect? And here we are today connecting with the first time homeowner workshop. And so I'm fairly new. I work here. This is my brokerage, Ocala Realty World. My brokers are some amazing people, Alicia Lopez and Luis Lopez, and they encourage the agents to do things to build your business. So this is how I'm building my business so that I can share the wisdom with you all. I'm a retired woman from FedEx after now it's 40 years. I worked for FedEx for 34 years, retired now for 6. And absolutely loving it. So when Denny was talking about using your 401 and different things like that, that's how I actually purchased my first home, through my 401 contributions. I withdrew the money and purchased my first home. So that is an amazing way how you can do it. Also, I'm a mother. Well, first of all, I'm married to my husband, Alan. We've been married for 41 years now. Wow. We have 8 children together, and we have 3 adult children, and we have now, I can't tell you how many grandchildren, but I have 4 grandchildren, and they're all here in Ocala. They just moved here. And so I'm full. I'm super full right now. I think that doing the real estate is going to help me with that generational wealth, right? Because I am comfortable right now with my life, because with me purchasing my first home at 18 years old, what I did, my mother, I was the oldest daughter, and I had 2 older brothers, but my mom had 9 children, and she divorced, and therefore we needed a place to live, right? And I seen a place, a sign on the side of the road that says auction. If you want to get a home or apartments or whatever, investments, auctions for sale. So come and, see what's going on. So I told my mom, I was like, on Saturday, we're going to go to the auction so that we can get us a home, right? Because that's what we needed for us. My mother was renting a place. The woman was super mean. So nor did she want to fix anything. She was one of the slum lords, right? That's what they call the landlord that do not want to fix up properties. So therefore, she was a slum lord. And I told my mother, it's unacceptable. We have to do something about it. I was 18 years old. So we did the bidding for a home, and we had our first, well, she had already had a home, but that was my first home helping her out, because when we got there, her credit wasn't the best, but I was already working at 14 years old. I had already had credit cards, so I've built credit, right? So my credit was good. I had money in the bank. I had a consistent job, so therefore I was able to help her purchase this home, right? And it was all good. So now, not only did that home give me my buying power, because now it also showing that I'm responsible. I've had this first house. Meet my husband, him and I, we the first year we together, we decided to build a home. I've always did the new construction for myself. So I love the new construction part of the real estate business, and it's good. So I've purchased, I have real estate, rental property, but right now my daughter is living in it. So quite naturally, it's for the family, right? Buying and selling my own homes, I've done that from the time I've owned a home. Never used a realtor, but that's the reason why I'm so passionate about it. I'm super passionate about what this real estate business is. I wouldn't be doing it if God gave me the vision, right? And I'm so, like young adults, my children, I've shared with them about real estate. Let's get you into a home, especially if you're making a ton of money. You're giving the landlord $2,000 for rent. That's a lot of money. You can go ahead and purchase your home, and then that gives you the wealth, the equity, so you can use it for different other things, right? So that's the reason why I'm here. So now enough about me, because you all hadn't introduced yourselves. I want you all to introduce yourself and tell me the reason why you all came to the Homeowners Buyers Workshop today. Let's start with Miss Catherine, because everybody here, we don't know who each other are. So let's introduce ourselves.
And I came because I've never owned a home. I live in an apartment, and they do make me a little ill. They're not really great at servicing, I think, personally, the tenants in the apartment complex. So I would love to own a home and have some equity, something that is mine. That would add to my wealth as well.
Awesome, thank you. And Miss Tirsa?
Well, my name is Tirsa Barreto. I'm here because I want to have my own house. I'm renting a house in Marion Oaks, and the renting is go up. So I just decided to have my own, and that's why I'm here.
Awesome. Thank you. Miss Karen?
My name is Karen Rushing. I'm here because I'd like to own a home. I live with my children, and they have taken me in, and it's time for me to have my own. It's been time for me to have my own. And so I'm here to try to find something and learn something, and I believe God.
Yes, awesome. And thank you so very much. And again, I would love to see people own their own property, because there's such power in it, right? It's such power in what we do for our personal lives. And I think that it gives us what am I looking for? The reason to really build our relationships, not only with just what we want, but what God wants for us, right? And when I say God, I'm sorry, on film, but I am a minister. That's another thing that I do. I'm a minister, and I'm just bringing that inside here. So when we come together as a whole, I want you to trust me. And it's not just because I'm a minister, but I want to bring integrity, because you have to trust people, right? Denny, he was talking about having that communication, that relationship. So it's so important that the people that you're dealing with, because a lot of times, we connect with these people and it's not right. So we're going to talk about, it's 10 tips that I want to talk about with the home ownership today. Number one, know what you're shopping for before you start. Sometimes our eyes and our hearts is so big that we're looking for something that we may can't afford, right? Yes, we want the bigger home. Yes, we want the nice neighborhood, but sometimes we can't get that. We can't get everything that we need. So before you begin shopping, understand that there are two homes out there that's vying for your interest. The one that meets your needs versus the one that fulfill your dreams. I'm a dreamer. I want the big house up on the hill, right? But whether or not I can afford it, it's a different story. So in a perfect world, you'll find a home that satisfies both. But since this isn't a perfect world, you're going to find yourself confronted with choices, plenty of choices. So, and that's where I come in at my expertise, because I'm going to help you navigate to not only what's going to fit your needs, but what you're going to be able to afford, and also a little bit of your heart desire as well, because we don't want to get something that we don't want. Where we want to live and how we want to live is very important, because you want to be in a decent neighborhood. You want to be in a place where you're safe. You and your family is safe. You want to be in a place where the riff is not going on, right? So we know that we have some of the neighborhoods like that. So I will help you choose that. When shopping, you're going to find homes that you fall in love with for different reasons. And that's why you should list the features that you want before you start shopping. So everything that you want, I tell my clients, okay, let's list everything that we're looking for in a home. Let's start there. And once we get that list together, then I know exactly what I should be looking for. The area where you want to go, like Vinny said, the shores, or where you want to be in Marion Oaks, whether or not you're going to be in Gainesville, right? Whether or not you want a condominium, a town home, or a single family home. So that's where that's my expertise. That's where I would come in at. Okay, and when we're doing that, we're going to satisfy some of our needs, some of our wants, and some of our desires. So we're going to, all of that, we're going to put it together. Then tip number 2, you need to shop for a mortgage. Vinny said the first thing you should do is maybe find your lender first, right? But I would say that when you get ready, you're going to say, you know what, let me find a realtor. Right? So if you get the realtor, then I'm going to say, you know what, we need to connect you with the mortgage broker, right? We need to talk to the mortgage man, because we need to know what your finances are. If you can't afford, you say, oh, I want to be over in a $300,000 home, but your finances say you can only afford a $200,000 home. That's the reason why Vinny is going to be there, so that we get to that pre-approval letter to know exactly what you can afford. Now, also, Vinny may say, oh, you can afford $400,000. I say, and I tell you, you know what, your mortgage payment is going to be $3,500. Do you really want to spend the $3,500, or do you want to, let's go a little bit below at the top of your budget and go down here, so that you can still travel, you can still go out for dinner, you can still do, shopping and so forth. So that's where I come in. We're not going to, you have to have a balance, right? How you want to live your life, whether or not you're going to be not stuck, but paying a mortgage payment that's going to be so high that it'll keep you from living a decent life, right? So we want to make sure that will not happen as well. So Vinny will give you his pre-approval letter, and he would let me know exactly what you're pre-approved for. You will have that letter with you, and so when we go and find these homes, the sellers will know exactly what you're pre-approved for. Pick a winning team to help you. So I'm the team. If I can't get it done, my brokerage can get it done. We have plenty of agents here that if I need some help, They will be able to help me. I have Denny, his mortgage company, will be able to. So we're the team that is going to help you get to the closing table, right? I'm going to be the agent. Denny is going to be the mortgage company. And then if we can't, anything that we need, we're also connected with other companies that can help us get whatever we need. So whatever we need to get it done. Make sure your realtor knows that you're looking for. Make sure your realtor knows what you're looking for. What are you really looking for? The house on the hill, over on the beach, stainless steel appliances. All these different things, you want to make sure you let them know what you're looking for, the needs, your goals, what are you going to use it for. So if this is your first home you're purchasing, you know what, in 5 years, I'm going to be leaving this house and I'll probably rent it or sell it and get my dream home, right? So if you're not going to live in it for a long term, I lived in my first home for 18 years. Like I said, it was a new construction. It was a pretty nice sized house for, just a few people, but we outgrew it. So then we lived there. The next home we bought was a dream home, right? Beautiful 5-bedroom, 3.5 bath. So those are the things. So when you, and what we did, we sold the home. It was double in price. That's equity. We used that equity to put on the dream home. Mortgage payment was low. So those are the things that you really think about when you're purchasing these homes, whether or not it's going to increase in value. You don't want a home that's going to decrease. We never know. But if you go into the right area, you don't have to worry about that because you already know that it's going to elevate, right? So you always want to be conscious of the area that you move to. Our number 4. Okay, I'm number 5. It's a cliche, but location, location, location. That's what we were just talking about. The location is so very important, whether or not that value. The Southwest is blowing up out there. That's where I moved to when I first came to Ocala. 20 years, it'll be 20 years next year. I came from South Florida. And when I got here, we had a realtor company to tour us around the entire area. We were out in the shores. We were out west, northwest Ocala, southwest Ocala, southeast Ocala. My husband was working at Cheney Brothers, which was off of 40, right off of the interstate, just a couple of miles away from the interstate. And I was working at FedEx office, which was at the airport, right off of 60th, right? We came here from a city, it was always bright. We had the lights, time lights up and down the road. So it was never dark. We came here, it was nothing here, y'all. It was dark, 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 right? So my husband was like, and I had to work on a night shift. I got off from, at 8 o'clock and, 9 o'clock at night. He was like, oh no, we're gonna do that. We're gonna get a place where it's gonna be good for you to just take a short drive. So that's how I got to the Southwest area. Beautiful area out here, and it's good. So location is very important. You want your work, if you're going to work, whether or not you're going to be able to, get there. You don't want to be on the road for an hour and a half because of traffic trying to get to work, because now, you'll be 3 or 4 hours a day on the highway instead of, just around the block or whatever. So location is very important. The number 6. Oh, any questions yet, you all? I'm sorry. Y'all have any questions? Okay. Number 6, use your agent to narrow the prospect list. We have 3 different, what I ask my clients. Let's find 3 different properties, because we're gonna go to some properties that you're gonna like, some that you're gonna absolutely love, and some that you're not gonna really like. You're gonna care for it, right? So we will find properties, and then we would do the pros and cons. What's the pros from your list that you have made, what your needs, your desires are. So you have that. We will have the homes that we've chosen, and then we will do the pros and cons on that so that we'll know exactly what's going to best fit your needs, what's going to be better for you financially, location, and just equity. You always, I tell people, always want to really find a place that's going to make you some money. I'm going to share this, and I'm not bragging, but each home I've purchased, I've doubled in price. That first home I told you, we spent like $70,000 for it. We sold it for $140,000. Our second home we bought for $225,000. We sold that home for $450,000. My home that I came here and I just recently, I did a new construction, lived there for 18 years, sold it, doubled that money, $200,000, right? So location is the key. When you come to a place where you really want to purchase a home, you want to make sure that you get in a place make a smart business decision. I'm a business person. Denny is a business person. Like you say, he owns his own real estate as well, right? So he has an investor as well. I do the same thing. I'm investing. I'll make sure that the places that I'm going to purchase, it's going to be beneficial, not lose money, but be able to put more money in my pocket. So you want to make sure that you do that as well. Our number 7, show a little interest in everything you see. As your 2 other homes on your short list, find something to admire on each. If you don't show any interest until you're finally fallen in love with a home, then you just put yourself in a competitive disadvantage, right? Because what happens when you walk into a home and you don't like the part of the house, but you go in the back and you love the patio area, right? So hold on to that. So you like the patio area. We go to the second home and oh man, the master bedroom is huge. I'm gonna be able to put all of my furniture there and have a little sitting area over to the side, right? So that's our number 2 prospect. Then our third one would be, we're gonna go in this home over by the lake and everything in it is absolutely gorgeous. And your heart is so full like this right here and it's beating fast. That's the house I want. But that house is and your budget is only $250. You're falling into love with something that you can't have, right? So that is off our list already. We know that we can't even go there unless you're gonna hit the lottery or something and come up with this money. But we need to make sure that, when we go looking for homes, you want to at least show some interest in something, so that if you find something that you really love but you can't afford it, we can always go back to the other 2 and narrow it down. You know what? You like the backyard. The master bedroom is not that large, but get the kitchen area, right? So we can always bring something else in it. Shop with your head, not with your heart. That's what I'm talking about. You have to make smart decisions. Your heart is going to be full, big, because we love nice things. We love lavish, right? So, but our pocket can't have it. So therefore, yes, Miss Karen. So we have any questions? Yeah, y'all come on, something.
This is not necessarily related to that, but that's a quick question. Do you find that most homes come with the appliances, or I know it's per situation, but not new construction homes. do people tend to sell the appliances with the home, or not necessarily? Is it like half and half or so?
Well, most homes, the sellers, they do bring sell the homes with the appliances because that brings more money to their pocket as well, right? And the new construction, a lot of them are also giving you all of the appliances. Some are not giving you the refrigerator. A lot of builders here is, they give you the fridge, but they give you all the other appliances. And I say, especially just to go and buy a refrigerator, you can go and spend $2,000 or $3,000. Why put that with a 30-year mortgage, right? So going to, but wait until after you close on it before you go and buy the refrigerator, so that therefore it's not going to hit your credit score. So you want to make sure that, but some of them, it's just depending on the seller, and it's depending on the builder whether or not they're going to offer those appliances. But in every situation, it could be different.
And then like kitchen and laundry, you'll find, or maybe not laundry all the time.
Maybe not laundry all the time,
Okay.
right? Maybe, and especially like sellers, some of them, they sell the washer and dryer with the home, maybe not. And a lot of builders, a lot of our builders here, like D.R. Horton, yes, but a lot of the other builders, no. So, yes, so it's just depending. And now, number 9, don't ignore red flags when evaluating a home, pluses and minuses. When evaluating the advantages and drawbacks of a particular property, be sure you know the difference between acceptable and unacceptable problems. That's where we get that inspection. When we get that inspection, it's very, very important. So you can have some issues with paint peeling, or the carpets are torn and different, or maybe it's a hole in the wall. When you get the inspection, they will give you all of that. Now, some of the loans will not allow you to go in a home that's damaged or whatever. A lot of the homes are sold as is. If you're getting pre-existing, it's as is. But even if you have a construction, you want to get that inspection. I just had a new construction. We did our walkthrough, and as I'm walking through, I noticed some things, so I have the blue tape. I've always had new construction, so I have an eye for it, right? Had the blue tape. The contractor, he's with me. He was like, wow, you got a good eye. Yes. But then I like, if it was my home, you have to take a ton of time. Your personal property, what you're going to spend your money for, you have to take your time to make sure that everything is done right. Everything is properly done, right? So if it's some things that you need to have fixed, that's negotiating power. If the roof is bad, you need to get that roof fixed before I spend my money, right? If the carpets are worn and damaged, you want to get the carpets replaced, or you want to say, you know what, because the carpets are damaged, let's take, a couple of $1,000s off so I can at least get the carpets done before I close on this property, after I close on the property. But the inspector, when you get an inspection, you get a licensed inspector that's going to come and do the inspection on the home so that everything is in working condition, right? And FHA, VA loans are very particular about some of the things that needs to be done at your home, but you want to have it done before closing, if at all possible. Sometimes if you go with with new construction, the builder will give you a piece of paper and say, this is, we owe you. So, and will list the things that they're going to do within the 30 days after you close or whatever. So those, you want to make sure that everything that's in that home is the way you want it before you sign those documents, because it's hard. You can get a warranty where you can have things fixed, as they come up or whatever, and it may be a little cheaper than you spending it out of your pocket. So don't ignore the red flags.
When you talk about the loans, I was going to say, back you up on that, FHA loans versus conventional. So if you're buying a home with an FHA loan, they're much stricter with, you know, the refrigerators. They're much stricter with the condition of the home. It needs to be very livable and safe. Versus a conventional loan, they're more flexible on, is the carpet, you know, in bad shape, or does it not have a refrigerator? So those are other factors as well that those I mentioned that are important.
And I guess my mind is always not going negative, but just what if, with the inspectors, are you like doing it like a doctor, getting a second opinion? Are the inspectors liable if they, you know, miss something and maybe you brought in a second one or something? Or is there any sort of liability?
So that's
to
a good question. So inspectors, they should have some type of liability insurance.
Yes.
Right? Now, the idea is that claiming is expensive and timely, right? And you're still gonna have a problem with your home, right, for a while until it's resolved, right? So not that you can't get a claim if they have liability insurance, but the goal is to try to prevent it as much as possible, right? So by hiring the right person, and then also you asking a lot of questions, right? So it's not him doing the inspection, it's you doing the inspection together, right?
Yes.
And that way, when you see things, you're like, hey, what about this? What about that? So you can kind of get them to bring things up, and then they're not a professional HVAC person, they're not a professional roofer, they're not an electrician, they're not a flooring person. So if something stands out that they flag it, then it's your responsibility to then go to the roofer, to then go to the AC, to also then further.
But they have some sort of base knowledge.
Oh, yes.
Of
For
construction.
sure.
They have to take certain coursework to do what they're doing there. And there's certain organizations they're a part of that, you know, that help you confirm that the person knows. So the answer is yes, that they liability, that they're responsible. But the goal is to try to avoid even having to go that route. Prevention.
Yes.
Right?
And they put it on their report. It's up to you to make sure that the seller or the builder get those things done, because you're one that's purchasing that home. So you want to make sure that everything that the inspector has put on the inspection report is done, because in order for him to come back to make sure that everything is done, you're going to give him another fee. So you want to make sure that, you know, it's already done, and the seller will have those different invoices showing that everything is done. Whether or not you need to get this window fixed, you need to do the molding over there on the garage, whatever it is, they're supposed to get professionals to get these things done so that, you know, it's no other problems once you close. So great question, I love it. And now that's the last one. Hire that professional inspector, right? So we took care of it all. And so therefore, if you all have any questions, now is the time to ask Denny and myself. Denny, if you would, please come up and just share the space.
Sure.
I appreciate you coming and doing this workshop with me. I thank you very much.
Thank you, Rosetta.
And I that this is not, you know, we're going to be able to do this often so that we can empower and build people up, especially in our own communities, right? That's what it's about.
I agree. Can you guys give her a hand?
Thank you all so very much. I appreciate it.
Any questions? I know we've kind of gone over some questions, so I don't want to put you on the spot if you don't have any questions, but
I'm full of questions.
Go for it.
Yes.
My mother did it. So my friend just bought home.
okay, great.
One thing I think she dealt with, I guess maybe, and I was wondering about the inspection thing, is somehow that home has an issue where when it storms and when hurricanes stay, it somehow has done something to the foundation along the edge of it. And so when the inspector told her that, they went to the seller and said, hey, are you willing to knock this off, because we're gonna have to put in like some thousand, and they told her no. But it was kind of like this, everything else was really great about the home. Do you all work to kind of convince the seller, or if they say no, it's just know, or how do you all help to maybe tackle trying to knock off that extra expense you do have to go into?
So the first thing I'll say, the negotiations are handled by Rosetta.
Yes,
She's a real estate
negotiate,
agent.
yes.
Now, however, there's things with the finance that also help support you and Rosetta. For example, if the financing is not going to cover, and if it's something going on with the home and you're not going to be able to get the loan, I'll write a letter or contact whoever I need to contact and say, hey, look, they're not going to be able to get this loan unless you fix this, right? And then Rosetta can, use that as a negotiation. Right?
Yes.
However, whether the seller pays or not, I'll leave that.
Yes. So if the seller does not they do not approve it, say, no, I'm not going to pay for it, then it's your responsibility whether or not you're going to deal with that or you're going to back out of the contract. Because if something is wrong with it that will keep you from getting that loan, getting the financing, you can't proceed. So they may say, well, let's do half of the money and then you do the other half. But you would need to find that professional that's going to be able to fix the problem to know exactly how much it's going to cost. And then the negotiation comes into play, right? So, yeah, that's
a great question, but yeah, that's
great question. Yeah, you have to be very.
Story, but okay.
Yeah, and that's a big one. I mean, at that point, you can, if they don't want to fix that or give you the money that you need to fix, and you probably want to back out.
Yes, for sure.
Yeah.
And it's nothing wrong with that. It's nothing wrong, and they will have to give you that monies back that you have put down because it's you don't want to get into it with a home, especially with a foundation
That's the
problem.
worst.
Listen, the foundation is the yeah, and we go
It's the
up.
skeleton.
So it's oh man, yeah.
You can't go walking around without feet.
No. So what happened with that?
I don't know. She bought it home, but
okay.
The story was weird in my head. I was like, huh?
Yeah, but
because Gainesville has a lot of trees. I live in Gainesville.
Oh,
okay.
And so behind her is like this bucket full of trees, and then her going down to her house is like a slope. And even Jamie had an issue with when it rains, it somehow floods the front. So the stuff cracks in the front. They have to build like a little moat or something.
Yes.
Around the home. And I was
Wow.
like, is that because it's so rain heavy, here hurricane heavy?
Builders should be able to build that land up. They from when they cut all those trees down and different things like that. But over the years, things may shift a little bit, but it shouldn't shift that much where the foundation is having a problem, unless you're in a sinkhole area where, because we here in Ocala, we have sinkhole areas. But that, is a biggie, and you will have to have that, insurance and different things, flood insurance, all of that. So if always flooding, it's always water, and the county makes it those zones. They know where the flood zones are. And we have to get that special insurance.
Okay.
And I would say try to avoid it if you're first time home buyer.
For sure. Yes.
Mortgage,
Yes.
and then
Yes.
less home that you can afford.
Yes.
It's kind of like the HOA.
Yes.
If it's a flood area, try to avoid it.
Yes, exactly.
Unless you're getting a really great deal, but again, it's a lot of risk. Any other questions?
I wanted to know about the US.
Okay, you want to get USDA? Well, one thing is, what question specifically do you want to know about it?
I'm interested in using US.
Okay, so we could talk offline and go over some of the details. But one of the things with the USDA is you can get 100% financing, right? So you don't have to put any money down, right? So that's a good thing about USDA. And then you could also roll in some of the closing costs too. I think it goes up to 102%, right? Now there are maps in where the areas qualify, right? And then what they're trying to do is trying to encourage growth outside of the cities, right? Outside of the suburbs and more rural areas. So I forget what areas in Ocala qualify, frankly, or Marion County, but I can get you a map. That's one thing, and then give you an idea.
A lot of the Southwest for sure. I know all up and down.
Not in the middle of the Southwest. I'm talking about like out there, probably. Yeah, there's the maps that I think.
Okay.
Yeah, because I live in the Southwest and I don't think I'm in the USDA area. But we can look.
Yeah.
Would that, I guess, if you were doing like a home, new construction, would buying property and the new construction go into the same thing, or those are two separate transactions? Like buying an acre and then getting a house built are two separate things? Could they be pushed together?
So it depends. So if you're buying a home from a builder, right, it's kind of like the same thing, right? If you're buying a piece of land and then you're building a home, I mean, you're still going to get financing probably to build a home. So it's kind of the same, right? I mean, you're still buying real estate. And then if you build a home, there's going to be a loan on it and everything. Is that,
Well,
I'm
you were
understanding your
kind of
question?
saying, don't start one loan purchase before you do your home thing. But would I need to buy the land before I can even think about getting the construction bill? Or can I merge them together in a transaction together, something to that effect?
So you can do one thing that she's been talking about is new construction when you work with a builder. They already have the land, they have everything.
Wherever they have it.
Yeah, they would. Yeah, wherever they have it. Like, you drove around here. There's houses in there. They're building houses. You like that neighborhood. You want to live around here. There's another one that there's a neighborhood and there's like land for sale, right?
Yes.
And then at that point, like you drive down here and there's a lot. And you're like, oh man, there's a lot here. Let me just buy this lot. But it's not a builder. You got to find your own builder. You got to find all the people to build it. You can do it separate ways. You can say, Denny, I want to buy the piece of land and build the home, right? Or if you have your cash, you can go ahead and buy the land by yourself or with a loan. I really don't do land loans, like just basic land loans, unless it's maybe commercial. But if you're gonna buy, let's say it's a piece of land, it's $10,000 or $25,000. You buy it cash or you buy it with a local bank. And then you come, hey Denny, I wanna build a house on my land. I already own the land. We have loans for that.
Okay, it wouldn't negatively affect me because I just took on an extra $25,000.
No, it wouldn't negatively affect you, as it depends. There's a lot of factors. How much is the land worth, right? How much, you're gonna try to build a house, right? How much is it gonna cost you to build a house, right? Do you have a builder, right? Building is a very, I'm building homes. I'm planning on building homes, and one of the things I'm looking to do, I've never built a home from scratch. I've done renovation projects, like hire contractors to do, let's say, a big renovation. But I've never built from scratch. And building from scratch is a lot of work. You have to talk to architects. You have to talk to engineers. You have to have the right builder. Builders, so it's
more money too.
It can be more expensive.
Yes.
Yeah. I mean, the builders that are building here, D.R. Horton, Lennar, NVR, all these building homes,
Bright Homes,
they're building homes like with, kind of call it discount store, right? The way that they build, the prices. They hire building thousands of homes. So the builders, that whenever they hire a builder, they're building in-house, so they're electrician, they're plumber. The homes are inexpensive. Now they sell it to you, and that's how they make their profit. What you're trying to do is you're trying to cut that middleman out. But frankly, unless you have a lot of experience, you're probably going to end up paying the same.
Yes, or more, because you can always hire the wrong contractor, which is a big, lots of, and we can give you some horror stories. So
and not that you can't do it. You can do it. I don't ever want to discourage, but I will say you just got to prepare yourself, in your stomach to handle it.
Yeah, because if you give somebody $100,000 to start building your home and they just decide you can't find them no more, your $100,000 is gone. This is literally gone, and you're trying to figure out how you're going to. So now you have to get another builder. Yes. The company. So yes, new construction is great when you're using these nice big companies that's what they do. Build new communities, and the builder is very well known. They have a reputation to hold up, all of this stuff.
And you still have problems.
And you still have problems.
So imagine you having your own contractor. This is the thing. If you want to, if you're willing to go through that, and you're willing to go through the headache, and you have extra funds, you're willing. Hey, but that's not. I know that wasn't your question. We went down a tangent, but
I like the tangents. Right? I'm used to it. That's how I talk. But I was just asking. But are you like D.R. Horton? Or what's the name of the company?
There's tons of
builders.
No, I was just using one as an example.
Yeah.
Oh, okay.
Are they building strictly in neighborhoods, or are they building ever, like, some people don't like living in neighborhoods.
Oh, yes.
And a lot of cookie cutter sometimes, or your yard's about this big.
Yes.
So I do like yards.
Yeah.
DR Horton only builds in neighborhoods.
No,
But
no.
I have other builders that
Yeah.
build outside of neighborhoods too.
Yeah, and
Large
they're
buildings.
now up the neighborhood as well, because they're building
They
up
are
and down.
on, too?
Yeah, they are all
Oh,
over.
okay.
Like Marion Oaks, their houses on the lots where you can get 3/4 acre or
There
a
you
half
go.
an
Oh, look
acre,
at
a
that.
quarter acre. Yeah, so
So then you
Yeah,
can go
yeah.
with them too. But
Yes.
there's other builders that I know that if you find a lot, they're builders. They'll build it for you too.
Mm-hmm.
But they're national. But again, it's not hiring a contractor. You're hiring a builder, like a developer. It's a different.
yeah, and with DR Horton, the lot is going to come with the home. They have already purchased the lot.
Yeah.
It's just not in the development or the neighborhood. It's going to be, in the community, out and about. Yeah, so they are doing some building with the lot and the home that's combined, where you have the
very.
beautiful lawn and everything. Yes, that's the reason why you hire your realtor license, Rosetta Harper.
There you go. I like it.
All right, appreciate you.
Anything else?
Yes.
Yes.
Oh.
Yeah,
You,
we're finished at 12, so we still got 5 minutes.
Okay.
Go for it.
I'm retired.
And I'm willing to talk offline too, but
Yeah.
just for everybody
I'm
else.
retired, and I don't work a job. I don't have a business. How does that? I mean, I know it affects getting a loan. I know it affects, the amount of money you could spend for a house and all of that. How does that work with?
Whatever your income is now, even if it's retirement income,
Mm-hmm.
that income is calculated for your affordability with the amount of debts that you have, right? So if you don't have, let's say you don't have any debt and it's just your income, and let's say you make $1,000 a month or $2,000 a month, half of that, more or less, can be used to pay for your mortgage. Now, do you want to spend half of that money on your mortgage? That's your decision, right?
Yes.
But that's probably more or less of what you can afford.
Mhm.
Yes, it's typically that, depending on how much debts you have,
Okay.
right? And then there's a lot of factors there, and how many house or how much is the house, because there's taxes, there's insurance, and where are the interest rates at right now, which I didn't really talk about that, but they're around 6% more or
Huh.
less. So
One question I have: mobile homes. Are you all
I
your
just
company?
did a mobile home loan, as long as it was on its own land.
Okay.
So not a park mobile home.
Okay.
A home on its own land, where you own the land. Yes,
Okay.
I can do that.
Awesome. So that means if it's a pre-existing mobile home on a piece of land,
Correct.
the age doesn't make a difference.
There is age, I believe it's like 1978, something
Okay.
like there, where the age can be older than a certain.
Okay, dope. Awesome.
And then we just did one. And then if it's to be basically what is looking how mobile homes work, manufactured homes is really kind of the term.
Yes.
It's manufactured in a factory, but it's just like even sturdier possibly than a regular home, right?
Mm-hmm.
And those homes, they put them on the lot, and first it's considered chattel, it's considered like a car, right?
Mm-hmm.
But what they do, they take the title and they retire it at DMV, and it becomes real estate. So then
Yes.
that has to be done, and once that's done, we can even help do it. The title company can help do that, and then you can get a loan on it. And that's
Okay.
what we did with this client. They had
Awesome.
a brand new home that they purchased, and then they were looking to pay off their debts.
My friend just bought a home, and she did it from, like, designed it, and it looks so different than whatever I was thinking in my head of the mobile homes I've
Yeah.
been to. It was high ceilings. They did it to where it's more planted in the ground.
Yeah.
Nice.
If it's done right, I mean,
Yes.
you can't even tell. You know?
My aunt had one I didn't know until I
Yes.
got front porch, back porch,
Yes.
brick around.
Yeah, you
It'd be
wouldn't know.
gorgeous.
I didn't know for sure.
And homes, sometimes they can't even be, they're made in a factory. They don't have the
Yes.
elements, they don't have a way. So it can be more affordable. Sometimes the cost is still the same, just because of,
And they have programs for that too? Mobile homes?
I don't work with programs, but I mean, if you're buying one, you can use it for anything. If it's already on its own land, it's a house.
Yes, it's a house.
It's
That's
house.
a
Same
manufacturer
thing.
home.
Now,
Yes.
if you're gonna buy a land and put one down, then that's different. Now you have to go
Mm-hmm.
typically financing with them because it's like a type of chattel or like a vehicle.
Yeah.
But then after that, then you can get financing.
But are you doing loans with the manufacturer home on it?
Yes.
Okay, awesome.
Yes.
That was a question. You can
Yes.
okay.
Yeah, I can do that.
Yes.
Anything else? I talked about interest rates. That's something I didn't mention.
Do you see I'm down any?
Oh, that was a question. What is the word? Forecasting. Right?
Yes, yeah.
What does the weather say? Is it gonna rain? Or no?
What's the prediction?
Yeah, what's the prediction? Okay, so I'm gonna make this one easy. Okay, the answer is I don't know. Okay, and
Right.
nobody knows. Anybody who tells you they know, no. Right. However, what is likely? The Federal Reserve, right? Interest rates go up and down every day, but the Federal Reserve controls the long term where they're going to do, right? More or less, they've been lowering rates. They said 6 months ago that they were going to lower rates by the end of next year, where the rate was going to be around 5% for a mortgage, okay? But within the last 30 days or so, that has changed where they may not reduce it that much. They really said they're gonna reduce how much, but other people are saying, and what I believe is after the election, that they're possibly gonna leave them where they're gonna stay around 6%. Because what they do, the reason that they lower interest rates is to get the economy moving, right? To get the economy pumping, right? But if they lower it too much, then the economy gets on fire. It gets too much and things get more expensive. So it's called inflation, right? We talk about inflation, right? If they put them higher, then the economy slows down, right? And then inflation gets under control, right? So prices stabilize. They don't go down maybe, but they stabilize, okay? With our new administration, what they're planning on doing is doing something called tariffs, right? Right? Tariffs, right? And tariffs, is a tax, okay? When goods come in, you have to pay more for those goods when they come from other countries, right? No matter how you feel politically, this is what they're looking to do. So that is inflationary, okay? That increases prices, right? That's one thing. Everything that you hear by American, it's inflationary, unfortunately, right? And the reason behind that is in the United States, we have higher labor costs and we have just higher manufacturing costs than certain countries like China, Vietnam, Mexico, right? So those are inflationary. I'm not saying we shouldn't do it because there's certain jobs that are important for the economy, certain jobs that we should protect, but all those things are inflationary, right? And the other thing that's inflationary is the debt, right? And the reason that is inflationary is we're spending more than we're taking in. So that money is creating more costs. So to not too technical with it, I think they're going to stay the same. And the economist of the Realtor Association, Lawrence Yun, said the same thing. Said that they're going to stay the same over the next year. They're going to be at about 6%. Maybe they're going to be 6.25%. Maybe we're going to be 5 3/4. Maybe they'll be 6.5 one day and 5.5 another. But it's going to be around 6.
Yeah,
For the
and I
next
think
year
it would
or
too.
so. Yeah, I don't see big changes there. And
But I think the key is, especially if right now it's not a price war, like you can get into a home, but if those interest rates go down to 3%, that's when those homes are going to skyrocket because it's going to be a bidding war again. People are going to be outbidding, bidding, and you know it, a seller would be getting $300,000-400,000 more for a house that's not worth it, right? So you want to make sure, and you can always refinance. So I would say, because I did the same thing when I moved here to Ocala, it was 2006. The economy, that interest rate was high. 6%. Within 1 year, I was able to refinance that home to a 2.75% and paid for it in 15 years. So that's all I'm saying. You have to be smart, use smart wisdom when it's down to real estate, and it's doable. And if you really want to be an investor or just really smart management, watch it. I always say if you get that 6%, the interest rates go low, you already have your home and you can just refinance.
yeah. And it's worth it if it's like at least maybe half a point or
Yes.
a point difference, because there's also costs to refinance. So
Oh,
want
yeah.
Your home, you don't want it to be like an ATM. You want it because the cost, right, will eat up your equity too. But if it's over half a point or 1 point, then that savings over time you'll make up for it.
Oh yeah, for sure.
Yeah.
Awesome. All right, so closing it up.
Yes,
That's
thank
a
you.
great job.
Appreciate you. It was good.
That was really good.
Very easy to understand.